If you're approaching retirement in the next 5 to 10 years and most of your assets are in those tax-deferred accounts, this video is for you. Looking at this example case study here, we can see that they have $109,500 in their taxable account. And then they have $657,000 in their tax-deferred account. So when we think about retirement income, let's suppose that they have an income gap. They're relying on their portfolio to fund their monthly retirement expenses. And so we can see here that, again, the lion's share is in that tax-deferred account. So from a tax perspective, what does this mean? Well, if we think about various things that we could do, one thing that comes to mind immediately is something called a Roth conversion. Does a Roth conversion for John and Lisa make sense? Is this something that they should consider? See, in retirement, they're going to pull first from their taxable account, then the tax-deferred account, then the tax-free account. Today, we can see here that at the end of their plan, they're going to have about $2.5 million. Well, is there something that we could do to help increase the amount of tax-adjusted ending assets for John and Lisa? So let's see what a Roth conversion up to the 12% tax bracket looks like. And for them, this is something that could make sense. Why? Because most of their assets are in those tax-deferred accounts. If we engage in a Roth conversion, we can see here that over their life, they could expect about $2.3 million more in tax-adjusted ending assets than the current strategy. What if we do up to the 22% tax bracket? Would this make sense for John and Lisa? And we can see here that this would result in $7 million more in tax-adjusted ending assets. Now, why is this? Well, this is because early on in retirement, if they retire early, say at the age of 65 and they aren't yet collecting Social Security, maybe they delay that and they pull from their taxable account first, their income is abnormally low. This allows that for them early on in retirement to start doing those Roth conversions. Now for John and Lisa, clearly Roth conversions are something that they should consider. But this isn't for everyone. It's unique to you and your own situation. The point here is every plan can be optimized. What can you do in your plan? What knobs can you turn to further optimize your plan so that you too can save more of your hard-earned money?